Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger and Associates Financial Planning. I'm pleased to have as my guest again today, Brad Sorensen, who is a chartered financial analyst and works with us as a consultant for Cornerstone Portfolio Research. Brad, thank you again for joining me.
Thanks for having me. Glad to be here.
We're now on a cadence that we're going to be having Brad basically at the beginning of each quarter. Generally speaking, we're going to do is 2 episodes, except when there may be something really outlandish going on, which seems like today or anymore. There's always seemingly a lot going on. But basically, the whole idea is that we're going to do 2 episodes. First episode is going to be talking about what's happened in the past quarter, and then the second episode on a move forward basis. For the sake of disclosure, today is actually October 10th. Yeah, Friday, October 10th. And God knows how everything changes so quickly, particularly with the government. Some of the things that we say could easily change between now and next Wednesday, which is when this airs. And specifically, the one is the government shutdown. Effective October 1st, the government shut down because there hasn't been a budget approval, so to speak, in Congress. Brad, you provided some information on that, which I thought was pretty neat, on the history of government shutdowns. Care to share that?
Yeah, the summary of that is that it does, there's always the combination of it doesn't matter, but it does matter. It matters to lots of people in the country, but it doesn't really matter to investors. And that's what the market has shown over the last 5 times. It goes back to 1995, that during these government shutdowns, the S&P 500 has either been flat or moved higher, just indicating that the market really doesn't care because the workers have gotten back pay, and really there hasn't been long-term consequences most of the time broadly for the economy from these government shutdowns.
But the one thing you did say was that if there's a shutdown of more than 30 days, that could create an additional problem. Could you share with me again what that was?
Sure. As those shutdowns get longer, the effects get more. Excuse me. Even the data, like we're not going to get labor reports, we're not going to get CPI, although they did announce that they're going to try to get CPI out. And then there's 750,000 people without a paycheck. And then that filters through to suppliers and etc. So that can just exacerbate the situation and take it longer to get over. So that could have an economic impact.
Sure. And if you're saying 750,000 represent 68% of the economy is consumer spending, if we're not spending simply because, or you got 750,000 who aren't spending because they're not getting a paycheck, that could have obviously a little bit of an impact on the economy. But wouldn't it then find itself builds up and then everybody spends the following month once they get their paychecks?
Yeah, and that's why there's not a lot of economic impact, because it does tend to even out over time. But I do want to point out that we're really fighting about 7 weeks. This is just a continuing resolution. This isn't about the budget. So we still have to get a budget done. So we could be back here again right around Thanksgiving. So that's at least something to keep in mind. But yeah, the pressure as government workers miss paychecks, especially the military, that's going to put pressure on Congress and the president. So it's more and more likely that they'll come to at least some sort of agreement to at least extend the current spending for a few more weeks while they try to get a budget done.
When's the last time they got a budget done?
Well, the way that the Constitution says you're supposed to get a budget done, that was probably before I was born, but they put these things in omnibus bills. They're supposed to do maybe 12 individual bills, but they do this massive bill. And that's part of why we have a debt problem, but that's going down a rabbit hole that we probably don't want to go down.
That's fair enough. I don't want to go down that rabbit hole either. So turns out that the third quarter we actually had some very good returns in the markets. And there's a chart that displays how the S&P 500, the NASDAQ, and the Russell 2000. The S&P 500 is, basically the 500 largest companies. The NASDAQ is a little heavily weighted towards the tech, and the Russell 2000 are small caps. So very interesting year we've had so far. And a lot of it is obviously revolving around the tariffs. But you take a look at this table, and you can see we got some pretty good numbers for third quarter and year to date. What's also not evidenced on this table is international is up 27% year to date and 6% in the third quarter. And emerging markets are up 31% year to date and 13% for the quarter. But international and emerging markets has a little asterisk because they've done so well. But a lot of that is because of the dollar drop, isn't it, Brad?
Yeah, that certainly has contributed to it. As the dollar has dropped, that increases these international returns. But there's also been money flowing to these. So it's a combination of both. And then there's the momentum that starts to go towards these as a result of really the tariffs and investors looking to diversify away from the United States into these more international markets where they perceive there to be more value. And the falling dollar is part of that. And that has juiced the returns of these markets as well. So it all kind of fits together.
Yeah, we had seen various charts demonstrating that international is very much of value relative to the U.S. You need to take a drink of water, Brad?
No, I'm okay. Sorry.
Are you good?
Yeah.
No worries. No worries. So, share why we had such a good quarter, because, the talk was when this whole tariff scare occurred in April that it was going to have a dramatic impact on earnings, and they expected that impact to appear in the second quarter, which, we all know earnings are really the driver of the value of a stock. And lo and behold, we had a terrific third quarter. Okay. They were supposed to really roll in, and everybody's talking that the second quarter is going to get hurt. No, it did well. And then it's like, well, it didn't really show up yet. It'll show up in the third quarter. Well, lo and behold, here we go again. The markets are on a tear. But earnings are coming up soon. But share with the audience, why did the markets go on a tear in Q3 as well as year to date?
Well, I guess the one answer is that markets like to surprise investors and that nobody really knows what's going to happen because predictions have often gone wrong. And this was another case. The other reason is because the tariffs, they are somewhat problematic, but the dire warnings that most people were putting out there about these huge problems for companies, these huge inflation, this huge cost increases, that really hasn't come to fruition. We've seen countries take some of the tariff hit. We've seen companies take some. So there's been a diverse mix. So it hasn't had the impact on these companies that we thought it might. So the earnings have actually held up very well. And like you mentioned, earnings are the lifeblood of the stock market. And really, tariffs haven't had an impact, to be honest, on AI. And that really has been the driver of a lot of the stocks. And even though we've seen a broadening out, the enthusiasm from that is spreading throughout a lot of the markets and keeping people optimistic about what's going on. So that's helped as well. And the impact from the tariffs is much more limited than was originally predicted. And one of my mentors says that absolute value of data doesn't really matter. It's versus predictions that matters. So when investors and analysts were expecting these huge tariff impacts, and then we see less, even if it is something, there's some positive momentum there that we can get. And we've seen that over this third quarter, as you mentioned, a very positive quarter really across all markets.
So that has had an impact on PE ratios. And PE ratios are nothing more than what's the price of the stock versus its earnings. And PE ratios have really begun to take off. And even Fed Chairman Powell, I forgot what he said, overly valued. What was the phrase that Chairman Powell said about the stock market?
Yeah, he said they may be a little highly valued. He was kind of he he wasn't the irrationally exuberance like Greenspan was back in the internet bubble, but he did say they were fairly highly valued was the phrase he used, and that didn't really spook the market, but it was interesting to note.
Yep. So let's talk about PEs. You created a couple slides here showing the PEs, and the first slide, which I know is really busy, and particularly for those people who may be viewing this on their cell phone, it's kind of tough to see. And for those who are audio only, then what good is a slide, right? But the PE ratios, this particular slide is showing it breaks out the S&P 500, which are large caps, the S&P 400, which are mid caps, S&P 600, which are small caps, and also shows the Mag 7, which are the AI driven stocks. And there's a huge difference in that, the AI, the Mag 7 have a PE ratio of 30, and the S&P has a PE ratio of 22.8, which is substantially higher than historic averages. Care to elaborate on that, please?
Yeah, and I apologize. Thank you. And I know the chart is busy, but one reason I put it in there is because there was such a divergence between these mag stocks, these AI related stocks, and the general stock market. As you mentioned, the S&P 500 at 22, that's modestly above the 19 historical average, where the 30 is quite a bit above that. So we want to differentiate between that there's some stocks that based on history are pretty rich, but the overall market is just a little bit expensive compared to history. So, and I do want to point out the valuation isn't a good timing mechanism. It just means that there's a little more risk in there. There's earnings have to keep up to validate those valuations, and we could correct valuations through a couple of different ways, through either time and earnings going up and prices staying relatively steady or going up less, or prices coming down. And right now we think that we're going to have the first of those, which is we don't think we're going to have a big decrease, but we think those prices will correct over the next few quarters as earnings continue to increase and maybe price increases in the stocks are a little bit less than we've seen. I do want to remind people that 24% S&P 500 gains are not normal. So that if we would go back to 10 or 12 and earnings are going up at 15 or 16 for some of those stocks, those PEs will start to come down. But right now they are quite elevated, especially on those bigger cap stocks, as you mentioned.
Well, a lot of people in 2023 and 2024 were comparing the markets today, particularly driven by the Magnificent Seven stocks, to 1999, where we had really high PE ratios and, we had the market on a tear, on a 20-year tear, but the tail end of it was driven by the technology. But it's much different this time. Can you share?
Oh, yeah, definitely. That there are some similarities, but there are much more differences. First of all, there's E, and the PE ratio. The E is the earnings. Back in 99, there were not many earnings in the internet space. There were, if you remember back, I'm not going to go too far into this, but it was a lot of clicks and how many clicks are you getting? And now we have these AI companies and these Mag 7 companies that are really generating cash hand over fist. Now, the price of the stock has gone up a little more than the cash has come in, but still, they're growing revenues and earnings quite rapidly. And that is a huge difference from the internet era. There are actually profits to underpin these gains that we've seen in these stocks. And that's why there's been a durable gain. And that's why people aren't as concerned And we saw valuations get into 50, 60 for some of these internet stocks, and we haven't seen that with the AI stocks as well. It doesn't mean that there's not some froth in these, that there's some enthusiasm that isn't fundamental based. It's just as much less than there was, and there's a lot of fundamental base behind the gains that we've seen in these AI stocks. Now the question will be going forward, is that can that continue? Do we start to make revenues off of the next generation of AI? Like we've got the guts of AI, and now we start to see if we can make money, which companies will make money, and how they'll do that over the actual use of AI. Now that a lot of more of the guts, the chips, and so forth are in place, so that's kind of the next step. But yeah, certainly there's a lot of profits underlying these gains, and that is much different than it was back in the internet era.
That's perfect. It's going to lead us into the next discussion, which is PEG ratios, which we'll pick up on the next segment. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained as I continue to interview Brad Sorensen, Chartered Financial Analyst. Thanks, Brad. So where we left off in the first segment is we were talking about the difference between now versus 1999. And the main difference is while we had growth stocks taken off in 1999 and we have growth stocks taken off now, the major difference is in 1999, a lot of them weren't actually making money. The companies now are making money hand over fist, as pointed out by Brad, which is a very interesting metric that is often used that I always liked. It's called the PEG ratio. The PEG ratio is the PE and its growth. So something can have a high PE ratio, but if it's growing rapidly, then it commands a high PE ratio. So for instance, if we had a PE ratio of a particular stock that is 30, but it's growing by 20%, then 30 divided by 20 is a PEG ratio of 1.5. So therefore, PEG ratios, if it's a PE of 30, but it isn't growing, well then holy smokes, its PEG ratio is going to be through the roof. So we have another slide on the PEG ratios. And what's interesting is I believe the PEG ratios of the Mag 7 are actually lower than the rest of the market, because we had a Zoom call 2 days ago with Brad, and we also had the chief investment officer at John Hancock, now Manulife, and we talked about this, and it was actually a slide they brought up in talking about the PEG ratios and how the PEG ratios of the Mag 7, even though their PEs are really high, their PEG ratios are actually lower than the rest of the market. Elaborate on that, please, Brad.
Yeah, you did a really good job with explaining what the PEG ratio is. It can kind of get a little bit complicated and wonky, but it's really just the growth rate of these companies justifying the PEs. And as you mentioned, these Mag 7 and these large cap growth stocks largely have growth rates that are bringing the PEG ratio down to historical averages. If you look at it on a PEG ratio basis, they're really in line with the broad market and their historical averages. They don't look expensive. The risk is, of course, that the growth rate doesn't continue in perpetuity, but right now it doesn't show a lot of signs of slowing down. So that gives some comfort to those that are worried about valuations or concerned about valuations, because there's the growth rates underlying that. And if you go back to, we mentioned the internet era, back then, PEG ratios were not low. They were also historically high because the growth rate in earnings wasn't there, because these companies weren't growing earnings because they didn't have earnings to grow. So that's really the key of this, is that the companies that are leading the market right now and have led the market for the last 2 years are the ones that really should be leading the market, because they have high growth rates, high cash flow, and they're continuing to meet those standards. Now, as we go forward, the ability to continue at that growth rate, that probably can't continue forever, obviously, because there's kind of the law of large numbers. You can't just keep adding exponentially forever. So they'll have to slow down at some point, but they'll still earn a lot of money. And that's when we'll see the PEG ratios. The PEs will come down a little bit, but the growth rate will come down a little bit. So the PEG ratio will stay roughly consistent.
Well, that's interesting. I like the chart just from the big picture. It's basically showing that our PEG ratios for large, mid, and small are all relatively consistent with historical averages. I mean, granted, you have ups and downs, but while on one breath, we're saying that the PEs are high, in the other breath, the PEGs being relatively consistent over history suggests to me that the markets aren't as frothy because the growth is supporting it. So to your point, does the growth continue? And I'd like to also add is it's much tougher for a giant company to double every year in size than it is for a small company to double every year in size. And what are all these Mag 7s? They're all mega super caps. So how in the world can they be having growth rates of a couple 100% per year? That just won't happen. That can't sustain, to your point.
Right. And that's why historically small cap companies have been attractive to growth investors, because they, as you mentioned, they have a lower base to grow. So they've been able to grow those more rapidly. But the growth rates of these Mag 7 companies, like I said, it can't go on forever, but it has been remarkable that they've been able to keep it up for as long as it has been, justifying at least somewhat the rise in the stock prices and the leading of the stock market that they've been doing. But we have started to see, as you mentioned, international, small cap, those things have started to perform better. So there is some rotation, and that also is a sign of a healthy market and the bull market being able to continue, because we're not staying focused on these 7 to 10 stocks. The investing community is starting to broaden out as they're starting to see international markets and emerging markets and small cap. They're not great, but the expectations are so low. Like you said, the growth rates are starting to improve, and they were at such a low level that helps the stocks to go higher because the expectations were so low.
So let's talk a couple more things before the end of this episode. Is real quick, the current status of the U.S. economy, referencing consumer and business confidence, but more importantly, a big thing. And I think we might find ourselves taking this into the next episode, really, because it is a move forward. In fact, now that I think about it, we will. So we'll touch briefly upon the labor market, because the labor market's big, and that is a driver in the future. So we'll touch upon it real quickly now, and then we'll pick up in greater detail in the next episode. So talk to me about business confidence, consumer and business confidence, and the labor market.
Well, I'm going to just put it together first. Why do we care about the economy? Well, because the economy feeds into these earnings. We said earnings are what drives these stock prices, but what drives earnings? Well, part of what drives earnings is the economy and how that goes. And consumer spending is 2/3 of the economy. So that's why we pay attention to those things, because it all feeds into those earnings numbers for these companies. What we've seen is consumer confidence, and that I told you a million times, I don't love consumer confidence because consumers lie. They may feel bad, but that doesn't mean that they'll stop spending. Americans have shown they'll spend no matter what, as long as they have money or credit. And that's continued this time. We've seen consumer confidence because of the tariffs and the media coverage, both sides just always harping on negative news on what's going on in the economy or what's going on in the world. consumer confidence is down, but consumer spending has stayed relatively constant. There was a little dip, then a bounce back, and now we're seeing it good. That's because the unemployment rate has stayed low. We're in the low 4%. But that leads into the labor market. We'll get more into this. But we've seen some softening, but we haven't seen a lot of layoffs yet. And that goes to business confidence. Businesses are unsure about what's going on right now because of the tariffs, although they're becoming more sure. And we've seen confidence levels improve a little bit. And those do matter because their confidence levels will influence whether they hire or fire. And right now, what we're seeing is a reluctance to hire and add to payrolls a lot because that confidence is lower, the uncertainty level is higher. So they don't want to bring on a lot of costs right now when they are not sure what the environment will hold over the next 6 to 12 months. But they also notice that their demand has really not dropped off a lot. Consumers are still spending. AI is spending like crazy. So they need to keep the employees that they have. So we're in this reluctant to hire, reluctant to fire environment that reflects this kind of lower but not depressed confidence. What we've seen is a drop, but now we're kind of in what would historically be considered a semi-confident environment. They're not extremely confident, but they're not depressed either. They're kind of somewhere in the middle there.
Well, one other topic I wanted to talk about, which I think we can pick up on the next episode, but I also think that I'd like to talk about the momentum. You have another chart here, which is very difficult to read, even when I print it large because of the resolution, and I'm not passing any blame. But what you see here is, 4 in the reds, negative, and you see 3 that are in the green, which are positive. And the thing that this is reflective of what? Year to date? Or can you explain what this, I guess that's year to date. So low volatility is minus 24%. Can you, and then on the flip side is you have size, which represents the big caps have done well. And then the one is momentum, which is plus 10%. But could you tell me what is low volatility? Explain that. And why did they do so poorly?
Yeah, and I apologize for the resolution. This is what happens when you take a chart from another source and then try to get it onto this chart. But I thought this was really explaining that. So there's always factors behind why stocks go up and down. A low volatility stock is one that really doesn't go up or down very much. There's some funds out there that are low volatility funds. They invest in stocks that are pretty consistent. The variation in their stock price is pretty low compared to the rest of the market. So that's what, you would see those in things like consumer staples usually, where they're not going to grow a lot. They're not going to decline a lot. You're always going to buy toilet paper and Kleenex and those kind of things. So there's just not a lot of demand explosion or depression in those. So that's low volatility. And when we see concerns about economic environment, those kind of things, those are the stocks that will do better. Same thing with dividend yield, which is the next one.
Well, I have a question.
Okay.
So you're telling me in one breath that low volatility don't go up or down much, yet we're in a market that is up, 15% or whatever it was year to date, yet they're down 24%? Is that what this chart is saying?
No, what this is saying is the low volatility factor, because there's different factors that go in. And that's a measure of what is contributing to these stocks. So low volatility stocks aren't down 24%. The low volatility factor, and they measure that, it's too complicated to explain right now, but they use low volatility stocks and then measures of that. So it's just a measure of what that's contributing into the returns of the total stock market. It gets a little wonky, and that's where I don't want to go, but it just shows that people aren't looking at investing in any stocks, really. One of the reasons they are is not because they're looking for safety. They're not looking for yield. They're not looking for those things. They're really looking on buying what's gone up. That's the momentum. That's what investors are doing is, hey, these stocks have gone up. They've gone up for 2 years. They're going to continue to go up. So let's buy these. They're not worried about stocks falling. They're not buying protection. They're not buying the low volatility stocks. They're not concerned about that aspect of stocks, the ability to pay dividends or yield or have low volatility. They really predominantly are concerned with whether that's gone up. Because it's gone up, they think it will continue to go up. And that's been relatively true over the last 30 months or so.
Well, thank you for that explanation, because now it makes a whole lot more sense. It falls under the FOMO, fear of missing out. Everybody's running for the stocks that are taken off, and they're leaving behind the boring ones. So, Brad, thank you very much. We're going to pick up on the next episode, which is going to air in a week and a half. And this is a little bit more on a move forward basis. So Brad, thanks for joining, and we'll be back in just a few moments to be able to pick that up. But for the viewers, thank you very much for joining us. I encourage you to check out the next week's episodes, which will be airing the following Wednesday, and be talking more about where we're going from here. So thank you for joining Financial Planning Explained. Have a wonderful day.